Coming up in today's show, stocks finish lower, led by a sharp sell-off in tech. Shares of Google owner Alphabet get smashed almost 10%. A look at Meta's earnings. Are Treasury bonds a good investment here? The latest out of the Middle East. What the new House Speaker means for cannabis legislation. And technical analysis of all the most important charts today. Hey, what's up guys? Hope you're doing well. Welcome to the Click Capital Daily Market Show. My name's Jared. I'm going to get you up to speed on everything that's going on in financial markets out there, and another interesting day on Wall Street for this Wednesday. We had Microsoft and Google report after close yesterday. Microsoft came in with strong results and traded up. That was the real standout today. And even though Google, Alphabet beat on expectations, their cloud business growth came in a lot lower than expected, and so that got smashed down today, almost 10%, which also led Amazon to come off 5.5%, even though we don't get earnings from them until tomorrow. Investors are worried their big AWS business is likely to come in soft as well. In addition to that, we had the semis come off really hard today, along with a few other spots in the market. Industrials and REITs were also hit. So first off, let's look at Alphabet, with them losing market cap value equivalent to the size of Nike in their worst daily sell-off in more than 3 years. And their results weren't all that bad. Their revenue was up 11% from a year ago and actually came in ahead of expectations, as did earnings per share, $1.55, ahead of what the street expected at $1.46. And apparently the street didn't like cloud revenue, which came in at $8.4 billion for the quarter, up 22% year over year. And that was only a little bit short of the street forecast of $8.6 billion and down from 28% growth in the previous quarter. And that was contrasting Microsoft a bit, whose cloud growth came in a bit better than expected. And just looking at the price action here in Microsoft, we gapped up to $3.45 a share this morning. However, sold off a bit, but still finished the day 3% higher. But look at that price action in Alphabet for just slightly missing on cloud growth revenue apparently by only $200 million, which is a drop in the bucket for a company the size of Alphabet, which even today still stands at 1.59 trillion. And for a stock that big to get hit 9.5% lower and still trading lower as I speak after hours is a pretty big move for the market. And that's what saw the NASDAQ actually break down to multi-month lows. And we actually closed below the low that we made on Monday. So that's not a good technical sign for the market. And stick with me because I'll get into the charts a bit later on and see what else we can find out there. But let's keep moving through a few earnings results that we're getting out today as we get into the thick of Q3 earnings season. Meta just came in with really great numbers, coming in a lot better than expected, actually reporting quarterly net income of $11.6 billion. Or $4.39 a share, compared with $1.64 a share a year ago, on the back of all those investments they were making in the metaverse, which the street didn't like. And then they pulled back on and really went on a cost-cutting campaign that appears to have paid off really well, in addition to the business just growing, with revenue climbing 23% on the back of a rebound in advertising, the monetization of Instagram and Reels, and AI-fueled ad targeting. They also cut their full-year outlook for total expenses by a couple of billion, and that was on the back of their reduction in their worldwide workforce of 24% year over year. So much like most of the tech industry, as kicked off by Elon Musk after he overtook Twitter, they have been trimming the fat in their labor departments. So in the regular session, on the back of Google, Meta actually fell 4%. And I'll just take you down to a 5-minute chart showing you the price action after hours here in the shaded section of the chart. So we closed the regular session at $299.54. Immediately after those results, we shot up to $316. Stock getting up almost 5%. However, right now, as I speak, we've rejected over that levels and are actually down after hours 0.9%. So just going back to the daily chart, we're currently trading around $296. Now that could change a lot by the time this video is coming out, and we'll have to see where we open tomorrow. However, if we gap down tomorrow on the back of those really good results and numbers from Meta, that gives you a really good idea on where the market's at the moment. Because like I said, it's how the market reacts to the numbers that's the most important thing. And quite often, big funds and algos will use the liquidity around earnings to reposition and shuffle their portfolio. And so far, it looks like they're using this opportunity to get out of the stock. Because on the back of those numbers in a healthy market, we could easily see the stock shoot up 10% or more, and that would be justified. However, that doesn't seem to be the sentiment we've got right here. Similar story in Mattel, who just reported earnings, and not even the very successful Barbie movie could save them. Their sales rose 9% to $1.92 billion. They increased their guidance for earnings per share and actually beat street expectations on this quarter by 25%. But again, here we are after hours and the stock is trading down 6.7%. We also just got earnings out from Boeing, and they reported a wider than expected third quarter loss. And this business has been in trouble for a few years now, ever since they had the problem with one of their flagship new products. Back in the first quarter of 2019, the 737 MAX had a few deadly crashes and that's really shaken up confidence in their business from both customers and the street. And in that time, we've seen their biggest competitor, Airbus, actually become the biggest airline manufacturer in the world now. And just looking at the price action, stock price has already been really weak the last couple of months and sold off again today to new lows, down 2.5%. And this is a stock I've been short for a little while now in my only bears portfolio, and my stock fair value indicator's still got it at $71, so we're still holding this name short. So we've got some really negative reactions going on to some good earnings numbers in the highly concentrated tech trade. However, there's still a lot of bulls out there that are saying we're going to get that end of year rally, seasonal bounce into the new year as we come off some lows. And specifically, stocks that have been hit hard this year should bounce after end of year window dressing and tax loss selling. And that is a pattern that can play out. It played out last year, I remember. Stocks like Tesla that got hit hard bounced really well this year. And some of those stocks lining up for this pattern this year are Advanced Auto Parts, First Horizon, Moderna, Dollar General, and a few retail names as well like Macy's, Walgreens, Foot Locker have all been hit hard this year. So the bulls are saying those names are going to bounce well in January. And we've still got a lot of bulls in mega cap tech, with one fund manager saying that a big rally is coming soon in them. That's the chief executive and investment officer at SIT Investment Associates, who says to keep faith in big tech, but also be ready for markets to soon spread beyond what he calls the Magnificent Eight: Meta, Amazon, Apple, Google, Microsoft, Nvidia, Tesla, plus Netflix. He said we're going to have a mild recession and that's going to cut interest rates. And he's still hopeful that we're going to see an end of year rally and a broadening of the tech-led gains we've had this year, and pointing to opportunities in AI. However, on the other side of the coin, we got Treasury yields still trading near highs that we haven't seen for 16, 17 years. This is ahead of data on third quarter GDP set to be released tomorrow, followed by the Fed's preferred inflation gauge, the PCE index, on Friday. And some are saying the US economy may have grown at an annualized rate of 5% in the third quarter, much ahead of expectations, and just reinforcing the higher for longer view that has currently taken hold of markets this last month or so. So even though short-term rate expectations haven't done much of late, market's still given about a 1 in 3 chance the Fed will hike again in January. It's the move up in the long end of the curve, with the 10-year and the 30-year currently sitting near highs. And a lot of the market just seeming to conclude that yields have peaked out because Bill Ackman covered his short. However, that is not guaranteed and we could still go higher here. That's why we've still got a few of the best minds on Wall Street, like Ray Dalio, given a grim outlook for the global economy, citing things like inflation, recession, the Middle East conflict, and commercial real estate. He went on to say, if you take the time horizon, the monetary policies that we're going to see and so on will have greater effects on the world. And you look at the world gaps, so it's difficult to be optimistic on that. And I think he's referring to the highly likelihood that the Fed is going to have to print the US out of a huge amount of debt and probably come back into the Treasury market to try and keep a lid on yields. Even the CEO of the world's largest asset manager, Larry Fink of BlackRock, predicted interest rates will rise further as he expects a slew of global trends, including populism and pushback against legal immigration to fuel inflation. And it's true, America, along with a lot of other Western economies, have imported deflation from China with cheap manufacturing and products. However, now we're looking to onshore manufacturing, which comes at a higher labor cost, and that is inflationary. And so just like billionaire real estate investor Barry Sternlicht says, the biggest victim of Fed rate hikes is the US government, as the interest repayments on that massive pile of debt soars. And he said rates have to come down because it's simply too unaffordable to sustain. And of course, as a real estate investor, he's talking his own book and he doesn't want to see rates go higher. As like a lot of real estate investors, their cap rates or rental yields are already at or below short-term rates. And so if rates did keep climbing higher, that's going to hurt a lot more people in the real estate market, which apart from commercial real estate has been holding up pretty good so far. And so with the Fed transitioning from 15 years of quantitative easing and printing money to buy up treasuries, helping to keep yields low, now into quantitative tightening, where they're not buying anymore and just letting those bonds mature and roll off their balance sheet, and thus a form of draining liquidity out of the system. And the ballooning debt that we've just added in the last couple of months alone, that's really given some tailwind to the bond vigilantes and treasury yields who are kind of pushing the government more and more into a corner. And a lot of the market coming to the realization that the US government may not be able to grow its way out of that 33 trillion debt mountain, which is on its way to hit an all-time high debt to GDP ratio. And this problem could get even bigger if we were to go into a recession and tax receipts keep coming down and widening the budget deficit, thus increasing the amount of issuance that Treasury has to do to fill the void. So that doesn't look like that big trend is going to change anytime soon, and that should help to keep yields on that long dated debt higher for longer as well. So even though the bond market's already completed a lost decade, in fact the most popular ETF, TLT, is back to levels not seen since 2007, 16 years ago. Some investors are using this opportunity to buy bonds, as they are saying strong returns can lie ahead. And it is true, because the single best predictor of future returns for bonds is the starting yield. It's kind of logical and makes sense. The higher the starting yield, the more the average return going forward, as we can see in this chart here, of starting yields versus average 7-year returns. However, we're still not in the middle when it comes to historical yields. But the higher yields go, the closer we are to the top, and the more room they have to fall, which gives the big tailwind to the bond market. And just looking at the price action in TLT here today, we came off 2.2%. Still really volatile, trading like a stock, and still trying to put in on a bottom. We've got a bit of a bullish divergence going on the DSI. However, my hidden divergence is still a bit flat, and we can see in the range strength is red, which means there's still a lot of momentum in this market. However, looking at my institutional buying indicator, has been green this last couple of weeks, indicating that some big money is likely accumulating here. However, that doesn't mean we're going to pop up tomorrow or next week. Like I said, it could be large investors starting long-term positions, and they'll probably keep buying the lower we go. However, technically speaking, with all this volume and stalling out a bit, the market is trying to put in a bottom here. Moving on today to Bitcoin and the huge rally it's had over the last week. On the back of optimism that a new spot Bitcoin ETF is just about to be approved into the market, which will really open the floodgates to institutional money coming in. Some are saying it's not just that story of the crypto being legitimized on Wall Street, but that Bitcoin could also be becoming a safety haven trade, as Bitcoin's correlation to the S&P 500 and NASDAQ has decreased over time, and we're actually seeing correlation between gold and Bitcoin now positive, and could be potentially rising on the back of that geopolitical risk coming out of the Middle East, and like a lot of people call it, digital gold. However, that's not stopping Bitcoin's number one public enemy, SEC Chair Gary Gensler, vowing strong enforcement against crypto wrongdoers, who filed 780 court cases and administrative actions against those in the crypto industry over the last year, and he is determined to not let the industry flourish and grow. However, has been losing that battle the last couple of months, and this is still ongoing. So looking at the price action in Bitcoin's holding up there pretty good, currently under $35,000 a coin, just a little bit here. Really technically overbought in the short term. We could expect a bit of a pullback and consolidation off that major resistance zone, but for the medium term, this move up bodes well for the coin. Moving on to the oil market, price of crude found some support today, even though we got some inventory data coming in higher than expected. As people pull back at the pump, we've got some supplies growing. However, there's still risks in the Middle East, but for now, there's no interruption in the Middle East oil supply. And with that pullback in consumers buying gas, that's keeping a bit of a lid on the price for now. However, it seems to have found support around that $83 a barrel, just currently sitting above $85. And so the main difference between now and the 70s Yom Kippur War, when OPEC back then did an oil embargo on US in protest of their support of Israel, which was being attacked by Arab nations back then as well. The difference now, US is the biggest oil producer in the world, and they learnt a lot from that, creating the Strategic Petroleum Reserve. And the West's long-term goal is still to get off Middle Eastern oil, become more self-sufficient with energy and clean energy. And we saw some production cuts by OPEC this year, and that's what's helped the US lift domestic output to the highest level on record, and it's probably incentivized those big deals we just saw in the oil sector, with Exxon buying Pioneer and Chevron buying Hess, as they'll have the full backing of the US government to increase US oil production as a strong political goal and to try and de-risk our economies from the Middle East. And speaking of which, I'll just give you a bit of a geopolitical update. As governments are large forces and players in the market, we do have to watch what's going on a bit. So there's still a lot of fighting in southern Israel between the IDF and Hamas militants. And President Biden and his team are trying to walk the line and appease both sides of the conflict and trying to work out a solid two-state solution for the Jews and Palestinians to try and live peacefully side by side, something that's never really happened before. And the United Nations and British have been trying to get this done for almost 100 years now. And especially after what's happened with that surprise terrorist attack from the Islamic extremists onto innocent Jews, it's highly unlikely they're all going to be kissing cheeks and making up anytime soon. But for the time being, Israel has agreed to US requests to delay invasion of Gaza, as the Pentagon is getting a lot more military assets and air defense systems to the region, in the expectation of retaliation from Iran and other militant groups in the region, and they're positioning for a full-on war over there, along with reports that weapons and other military assets are being sent to the West Bank inside of Israel, fueling fears of a new war front developing there. All backed, funded, supplied, and supported by Iran, just like we're finding out that the Hamas fighters were training in Iran before the October 7 attacks. And Iran's been poking away at the West for decades now. I'm sure a lot of you remember back in the Bush years, after Iraq, we got close to a confrontation with Iran. Trump actually took out the number 2 man of their country, their military leader, from the skies. In a warning to them, however, they keep training militant groups to come after the West and our allies. So this very well could warrant a big response from the West militarily, instead of sending them tens of billions of dollars to try and promise not to create nuclear weapons, only to take that money and fund militant groups. So still very much a fluid situation, and stick with Click Capital because I'll keep you updated on everything that's happening here and how it affects financial markets. Also out today, the clowns in Washington finally managed to get their act together and elect a new House Speaker, Mike Johnson, a Louisiana Republican, known for his conservative stance on social issues. And that's not good for cannabis investors like me. As his history has shown, he's a staunch opponent of marijuana reform. He's voted against the Medical Marijuana and Cannabinoid Research Expansion Act that President Joe Biden actually signed into law. He also voted twice against the Safe Banking Act. And he, like many others in Washington with power, just seemed to continue to ignore the science, data, and the will of the American people at large who want cannabis legalized, most likely appeasing his big pharma corporate masters. On top of that, we've got a rumor that the Federal Health Agency is trying to redact their marijuana scheduling recommendation to the DEA, as currently cannabis is a Schedule 1 drug on the same level as heroin. And on the back of that news today, saw the cannabis ETF MSOS down 8.4%, losing a support zone here. So that's not a move in the right direction for this sector. However, we've still got the Safer Banking Act trying to go through Congress. However, according to the GovTrack website, this bill still does have a 68% chance of being enacted. However, we really need the DEA to reschedule it, and that should open the floodgates to more legislation and legitimizing the industry, just as Biden promised in his campaign. But we're holding out on politicians to do the right thing, so I wouldn't be surprised if they stuff it up again. And for now, this still remains a bit of a punt. However, I'm in this sector for the long term, and I'll hang in there for as long as needed. Just moving on through the data, we've got the Fear and Greed Index still at 30. Market's still on shaky ground here, and corporate insiders really not showing up to this dip and doing any buying at these low prices, actually recording one of the lowest amount of purchases all year. Was a busy day in the options market for a Wednesday, coming in just under 43 million contracts traded and slightly more puts than calls. And just looking at my institutional buying indicator for the S&P 500, still at neutral, just under 50%. And S&P 500 oscillator just sitting right above the overbought zone at 40.5. And stick with me because I'll come back to my chart analysis of the S&P 500 at the end of this video. Let's just look at all the other major market categories out there today. International stock indices were pretty flat. Some came off a little bit, like China and Japan and Australia as well. Now all kind of sitting down at the bottom of this support zone that we've been trying to make a bottom the last few days. Hard sell-off in tech saw volatility rise today with the VIX finishing above 20. We've got the NASDAQ VIX VXN sitting at 24 near highs, and option dealers still wanting a pretty sizable premium over realized volatility. Bit of a jump back in crude oil volatility, now at 44.9, and a bit of a jump here in put-call ratio. Market getting a bit nervous trying to hedge here, and the breadth in this market's just really waning. 14% of stocks above their 50-day average, and once again, really deteriorating as measured by the amount of stocks making new lows versus new highs. Again, breaking out on the NASDAQ, 267 to 14. That adds a heavy weight to the entire market. Bit of a turn down here in the growth versus defensive sector spreads, getting close to multi-month lows. Big turn down in high beta stocks versus low volatility stocks. Off almost 3% today, the worst day in months, as a bit of an indication, bit of risk coming out of this market and a bit of a defensive rotation into the less volatile names. Same with growth versus value back underneath its 50, and a bit of a jump up in the Dow versus NASDAQ after having found support, and commodities versus stocks still back on the march higher, along with the safety haven trade, gold versus treasuries, and inflation expectations still holding up there. Along with the dollar index at 106.3, and commodities sold off a bit this morning, but did a really big dip buy and just holding their 50-day now. And there's a look at gold consolidating right under $2,000 an ounce. Looks like it's only done a shallow pullback and dip bought straight away. And this market's responded the best to what's going on in the Middle East, and we're still only about $100 an ounce away from all-time highs at $20.85. Over to stock sectors, every sector finished in the red today except for two. Consumer staples and utilities, the winner. Like I said, a bit of a move into the defensive names and out of growth with semis down almost 4%. Pretty big move there. ARC given back yesterday's gains down 5.2%. IPO stocks down almost 4%. Communications down 4.3%. as Meta's the biggest component in that, and others continuing to get whacked like biotech and REITs finding new lows today. Same with BlackRock, breaking down lower lows, lower highs, and Chevron still coming off a bit after we got that news of the big deal of them swallowing up Hess. Got earnings from them in 2 days, but technically oversold here. There's the big fella Apple coming down to multi-month lows. Just the latest look at Google after hours, still trading down 2.2% now. That's really not a good sign for tech or the market as a whole. And the big one we'll be looking at tomorrow, Amazon, which was already really weak today, down 5.5%, which has spooked a bit of the other mega cap techs. NVDA down 4.3% in the regular session, down almost another 2% post-market. And Tesla looking a bit soft here as well, down almost 2% regular market, another 1.5% after hours. And price action not looking too good on Tesla there. So a good chance we're going to go under 200 over the coming days and weeks. Another big chip maker, AMD, finishing on lows. So over to meme stocks, bit of a sea of red out there. So we can see the pointy end of the market coming off a bit. There's Visa holding on to yesterday's gains after earnings. Same with Coke. Bit of a reversal there, and Spotify had a great day yesterday. And the defense contractors all having a good day. It's Lockheed Martin, Northrop Grumman reporting tomorrow, L3 Technologies as well. And we actually just got results today from General Dynamics, coming in with a slight beat on both the top and bottom lines. Market liked that, finished up over 4% on good volume. And a little bit of a bounce in those snack makers, and continuing rally on NextEra today. And some of my other favorites, General Motors, trying to find support here on a hammer. Same with Walgreens, and 3M pulling back a little bit, along with the telecoms, and continuing in weak price action in the financials, with even the big guys trading down to lows as well. Okay, so there's the S&P 500 sitting at 41.86. There's the equal weight S&P 500 actually looking to close below its support zone I've had in here for a while. Obviously the loser today was the NASDAQ, and it wasn't just the big guys, because we can see that in the NASDAQ equal weight actually breaking down as well, along with mid caps losing their support, the Russell coming right down to the bottom of this support zone, and obviously micro caps still really weak, finding lows again today. So really not good price action in the stock market, like I've been saying for a while now. There's a lot of downward momentum. You can see that in my sector trends table indicator, mostly red out there in the immediate short, medium and long-term trends. Most sectors below all their moving averages. And also my market risk on-off indicator, which looks at a bunch of things underneath the hood: market internals, breadth, technicals, volatility market. And that started flashing red back in mid-September after being green for a little while here. And now we're back in red today. So the market is in a risk-off mode. Just turning on my trend candles indicator, we can see a downtrend in the S&P 500 and the NASDAQ as well. So this is not a good move for the NASDAQ here, closing down below this support from late September on volume, and after hours as I speak, we're getting sold off pretty heavy, down 0.7%. And this has been one of the few days this year we've actually finished down more than 2%. It's been a really low volatile year. So the market does have the potential to uncoil and unwind a bit here. It's got the ingredients of high yields, potentially big war in the Middle East, and most importantly, the market's reacting really negatively to some earnings reports. Google actually beat expectations. They only came in $200 million softer on cloud revenue. The market sold them off 9.5% today, and we're down 2.3% after hours. So we'll see how we go on Amazon tomorrow, as it's traded really weak today, along with the chips in NVIDIA, and this one could be the last shoe to drop. With this head and shoulders pattern on NVIDIA, we've got the neckline around 402, so if we get a close below that, that could really open the floodgates for more selling and a bit of a change in crowd psychology, and a lot of people's positions in this. They'll start seeing their profit get eaten away, as it has been the best performing mega cap tech stock this year, and the leader of the whole AI story that the bulls are hanging their hats on. Otherwise, we've got the next big support on the S&P 500 around 4100, and we'll just have to see where the market can find its footing, because to me this market feels pretty heavy and weak now, and things could be beginning to ramp up. That's all I got for you today. Thanks very much for tuning in to the Click Capital Daily Market Show, and I'll see you guys again tomorrow afternoon. Cheers.